So welcome back, everyone. I hope you enjoyed some thought-provoking breakout sessions just now. We are now coming to our last and very relevant agenda point, which will give us some clarity on the most important forces driving our economy. Before we welcome our expert on stage to talk about this, I would like to ask you the following question via Slido. Can we please pull up our Slido question? There it is. Great. Okay. So, in your view, which factor poses the biggest threat to financial market stability in the year ahead? Is it rising national debt, i.e. bond market jitters, an AI bubble, geopolitical instability, trade tariff uncertainty, or higher inflation? Of course, all of these are interconnected, but we would like to hear which one you think is the biggest risk for financial market stability. Please scan the code, type in your answers, and send them in. We will reveal those answers after Dirk's presentation, who I would like to introduce right now. Dirk, can I ask you to the stage, please? Thank you. So it's time now. I'll give you a few more minutes. I've got 25. Oh, and also before I go on, it's important to mention you can only select one. Okay, now it's time for our last keynote of the day, which will be presented by Dirk Effenberger, who is the head of investment risk at the Chief Investment Office of UBS Global Wealth Management. An economist by training, he leads the team behind UBS's Global Risk Radar publication, which helps clients understand and manage economic and geopolitical uncertainties. Dirk also teaches at Coursera and the University of St. Gallen. Today he will tell us about the major risks shaping markets right now and what investors should watch next. Dirk, we look forward to hearing your presentation.
Thank you very much. Good afternoon, everyone. I hope you have had a good day so far. Very exciting agenda I have seen. I'm curious to see the results later on. We did a similar survey with our clients with family offices, and I'm going to show you the results as well just before I think we see your thinking. I think the reason why they put me at the end is that they thought after discussing economic and geopolitical dynamics, you really need a pause, you need a drink to digest. But frankly, my outlook is not necessarily negative. On the economic side, I think my outlook is constructive. I think we're going to see resilient growth at a global level next year. On geopolitics, I think we know our hotspots. I think we now have a better understanding of the geopolitical dynamics compared to, let's say, 3 years ago. I think what is more an open question is, what are the long-term consequences of those geopolitical trends? And how do we handle the consequences? I think that's not fully clear yet. How do we handle geopolitical consequences in our business life, you as an investor relation manager or me as an asset allocator? I get back to all these points in a second. With the remote control, it's this one. Yeah, very good. Let me start with economics. I just mentioned I have a reasonably constructive outlook. What does it mean in terms of numbers? You see here the GDP forecast across the major countries, which we penciled in. We just published last week our year ahead outlook. You may have seen it, and if not, please look it up in our ubs.com webpage. So the blue bar basically reflects this year, and the dark bar reflects next year. What you see is a declining real GDP growth. So how does this fit with my assumption of solid and constructive outlook for next year. Don't overinterpret this somewhat declining trend. If you look at USA, 1.7 compared to 1.9 this year, this is not a huge difference. And well, admittedly, if you're going to ask an economist to come up with a forecast and the difference is 0.1 or 0.2%, don't make too much out of this difference. This is within the margin of error, I would argue. And admittedly, for the US, currently it's really difficult to make projections given the lack of data quality and also the lack of data availability after the US government shutdown. So that's one point. A second point is, I think if we departure into next year, the turbulent phase is rather in Q1 and not necessarily later in the year. So the reason why we have a lower number here for most of the countries is that we expect some economic softness coming up pretty soon and not over the course of the second half of this year. Why is this? The main reason is basically the lacked impact of higher tariffs on the global economy and especially the US economy. So we expect that the kind of drawdown on consumer sentiment in the US is only yet to come in the first quarter of next year. The same, by the way, applies to inflation. So we expect a peak in inflation by Q2 next year, and after this, inflation should actually fade. There's not much talk about tariff anymore after I think Switzerland managed to get from 39 to 15% tariffs, but even beyond Switzerland, there's not much talk about tariffs anymore. I think this is not justified. Keep in mind that the global effective tariff rate is now 6 times higher than just 12 months ago. So we are at 15% effective tariff rate from the US for exports or imports into the US. That's 6 times higher than just 12 months ago. And this clearly will have and has had an impact on global markets. With respect to other countries, you see the numbers. China is a bit of a separate story. I don't go into the details. A bit impacted by housing market concerns here. Eurozone is going up slightly, well, staying at around the same level, just trend growth 1%. The same applies to Switzerland, where we also penciled in 1.3% for next year. We have 2 Swiss bar charts here. I'm not sure you recognize this. One is our outright forecast. The other one is adjusted for sport events. Any clue what it means? You know? No. The reason is basically, I'm heading a global team. I didn't know either, so no worries. The reason is basically that the major international sport organizations are sitting in Switzerland, and once there's a bigger sport event like the Olympic Games, you have the revenues coming into the international sport organizations, and that counts and that contributes to the Swiss GDP. So it's a bit of artificial bias. If you have a sport event, ultimately the GDP, which is being announced, is a bit higher than it would be otherwise. And next year we have, what do we have next year? The World Cup, exactly. And Olympic Winter Games, no? Okay, good. After clarifying this, let's move on. All right. Let's take a bit of a closer look into the US, because that's clearly the key market, right? It still drives everything in terms of economics, but admittedly also in terms of politics. But we go to politics in a second. Just briefly, I mentioned already inflation, we expect to peak in Q2 next year. Afterwards, it should gradually decline. What does it mean for the Fed? That's important, because markets are currently supported by the outlook of an easier monetary policy in the US. And we would agree. We would expect 2 more rate cuts by the US FOMC over the next 3 to 6 months. The market is actually pricing in even more rate cuts. The market is pricing in up to 4 rate cuts by end of next year. So it's a bit more than what we would expect. But anyhow, rate cuts are supporting 4 risky asset classes, and that will remain the case. One of the very few central banks which will continue cutting rates, SNB will probably stay on hold, ECB will probably stay on hold. UK is another exception where we would expect rate cuts next year. I think I mentioned growth, so no reason to go into this. Let's take a look just very briefly on Switzerland. All right. This is strange. There's something wrong with this. All right. It doesn't show Switzerland. So Switzerland is the upper blue bar, as you can imagine. We came from 39% tariffs, and now we are in the camp together with Korea, Japan, and Eurozone, which you don't see on this slide, I think. Apologies. So this is good news for Switzerland. Switzerland was able to bring down the effective tariff rate from 39 to 15. That's good news. Again, relative to 12 months ago, it's much, much higher, right? And I think it's important to put this into context. What does it mean for this for the Swiss GDP? That's shown on the right-hand side. 80% of the exports are not going to the US. Out of the 20% exports going to the US, only 4% have been impacted by the tariffs, because the other pieces, as you see, are services, it's not tariffed, and then exempted goods, which are not tariffed either. And this is primarily pharmaceutical goods, right? And so only 4% of all exports are actually impacted by higher tariffs. So this is additional good news for the Swiss economy. Also one reason why we actually expect the Swiss economy to grow at trend rate this next year. All right, so much about economics. Let's go to geopolitics and risks in general. Have you made your choice, by the way, already? So this is our kind of overview how we would see risk or the key risk for next year for financial markets. Also, this is part of the year outlook which we published. So what can cause major market weakness next year? In our view, there are a couple of points, obviously, and I think all of them are shown on the survey earlier on. I would probably personally add geopolitics as a standalone topic, and I get back to this in a second. You also see how these risks are interconnected, right? That sometimes people underappreciate, because if you have increased tensions of US-China conflict, and this leads to limitations of semiconductor deliveries, for example, then you certainly have higher risk of an AI disappointment, and that leads to economic weakness. So all of this is certainly connected nowadays. All right, let's go into some of those topics, not all of them, because we, of course, have time constraints. AI. I mean, this is a big topic for, I think, everyone for different reasons, I would say. And let me give you a few numbers which are not shown here, but just on the piece of paper in front of me. So the top 9 US tech stocks have driven 72% of the growth of the Russell 3000 US equity index. Top 9 stocks in an index of 3,000 companies have driven 72% of the performance. Another statistic. The IT sector now accounts for 36% of the overall world index. That's the highest weight of any sector, and the highest weight IT sector ever had. Then thirdly, the investments in AI infrastructure was responsible for almost 1 percentage point of real GDP growth in the second quarter of this year. So remember, the real GDP growth of the US in the third or in the second quarter was around 3% plus minus, and 1%, so one third of it was exclusively driven by IT. So that's huge. That's positive. But it also makes me thinking, because if an economy is so much dependent on one single sector, then obviously if something happens with that sector, it kind of leads to spillover for the entire economy. And that's a risk in itself. And we had these kind of bubble risk in the past, right? You see on the left-hand side here, this one here, the 2000 .com bubble. If there's interest, I can go into the details why I think the current situation is not comparable with the .com bubble. But we had this type of risk. There's a risk of a bubble buildup. Certainly, it can also take longer until a bubble bursts, finally. And I don't think the IT or AI, whether it's a bubble or not, will burst anytime soon. Just on the left-hand, sorry, on the right-hand side over there. Is that right-hand? Yeah, it is. My colleagues from the equity team made a bit of comparison. So CapEx spending, so the investments these companies spend for capital expenditure, is around $5 trillion US accumulated over the next 5 years. That's a huge number. Ultimately, this is 1% of GDP. How does this compare with innovations in the past, which kind of breaking innovations in the past, like railroads, like the IT hardware built up a few decades ago. So ultimately, back then, spending on infrastructure or spending on investments was much higher than today. So there's still some room potentially for a CapEx build-up. I think this topic will be with us, and there will be renewed discussions about the bubble build-up, but I don't think we are there yet. On the other topic, which you have seen on the graphic before, government debt. Do you remember the Maastricht criteria? Do you? I'm glad you do. Politicians, I don't know whether they remember. The scale starts at 70, and by the way, sorry, maybe I should go one step back. Maastricht criteria obviously define the criteria that each country had to meet to enter the Eurozone. And one criteria was debt to GDP ratio shouldn't be above 60%. And you see the scale here. Where does it start? At 70%. Come on. So we are far from this 60% threshold. I'm not saying this 60% threshold should be applied to any country, but clearly this ratio has gone up dramatically over the coming years, and the IMF, this is the blue line, reflects IMF forecast, so the forecast of the International Monetary Fund, projects that the G7 GDP, debt to GDP ratio on average will rise to 135% over the next, I think, six years roundabout. So that's a worrisome development for sure. Again, I don't think there is a major breakdown of sovereign debt of some of the major countries this year, but this is definitely a long-term story, because either a country goes bankrupt or it kind of grows out of the rising debt issue. A third option is clearly that you have financial repression, and I think that is actually our base case, that countries choose for financial repression, which means lower real interest rates going forward. And I think we see this in the US very clearly, where the Trump administration advocates for much lower interest rates, irrespective, I guess, of the inflation level. And that leads to lower real rates, which is good to lower your debt level in real terms. So there are a couple of questions attached to it, and if interest, we can go into the details. But let me also cover geopolitics in its own rights. And I think there are many topics on the radar for next year, even more topics than would fit on this single slide here. But let me mention a few. So trade policy is still with us. I don't agree with the current narrative. This is a story of the past. It's still with us. We have the Supreme Court decision coming up with respect to tariff policy, which means that ultimately the Supreme Court in the US will decide whether 70% of the current tariffs in place are illegal or not. And this decision will come up more likely in Q1 next year rather than this year. But it will have consequences for the tariff rate going forward. Even if the Supreme Court will decide that current tariffs are illegal, or at least 70% of the current tariffs are illegal, I strongly believe that the Trump administration will find alternative ways of building up tariff wall against other countries. Fed leadership is another topic. There will be a change in the Fed government chair beginning of next year. That raises questions about independence. Then we have midterm elections coming up in a year from now. I think the closer we move into this, the more it will be discussed in media. We look back at history to see whether this has had a market impact in the past. And this chart here shows the 3 months prior to any of the midterm elections since 1946. So every gray line reflects one midterm election. And then you see the average, the blue line, which it's quite interesting because if you go into the midterm election, markets are moving sideways. They're kind of doing nothing really. And then if the midterm elections are out of the way, usually the markets are moving up. Is this a pattern we can apply this time around? Well, I like these historical studies, but I think we have to interpret this very carefully because is the current situation comparable with any situation in the past? Maybe not, because I think the current situation, political situation in the US is rather unprecedented. So in my view, it can lead to somewhat higher volatility than what we see on this single chart here. All right, conflicts. One short single word, but so much behind this. This reflects a couple of topics, which I hopefully have time to go into in a minute. But first of all, let's take a look at what geopolitical conflicts mean for markets. There are different views out there, and many myths attached to it. One myth is ignore geopolitics because it doesn't matter. You can look through it. It only has a temporary impact on your assets. I don't agree. I'll tell you why. But where is this rationale coming from? It's coming from statistics like this. And again, I like historical comparisons, but let's be clear. Let's interpret them in the right way. So this basically shows geopolitical conflicts, events since Second World War, and how it has impacted the S&P 500. A lot of events, no reason to go into each single line, of course. The bottom line is that there have been only 2 events which had a more lasting impact on markets. And with lasting, I mean more than 6 months, which is the Second World War in itself, and then the Yom Kippur War in the 70s, which, as you know, led to an oil price supply shock and an increase in the oil price. And that had an impact on the S&P 500, which was negative and were longer than just 6 months. In all other cases, the impact on markets was limited. And the impact on markets here means on the S&P 500. And that's my concern. Because if you are invested in, let's say, Venezuela, in one of the regions where a geopolitical conflict happens, then clearly you are more exposed than just with the S&P 500. And also, if you look at a company level, and I think that's your concern, obviously a company is much more exposed, or can be much more exposed to a geopolitical events than a well-diversified global equity index. So there are different channels through which geopolitics can affect markets. Sentiment, macroeconomic channels like energy prices, inflation in several countries, in major countries, central bank policy, and last but not least, also physical damage to single companies. So where do I operate? Where do I have my production capabilities? Am I exposed to sanctions if there's a war emerging in one or the other countries? I think these are the key questions on a more company-specific level. The IMF has done a great framework and template to kind of show the transmission channels around there. I have this here. It's complex. I don't go into the details. I just show it quickly. I like it because it kind of explains the transmission channels. But again, it requires a bit of time, which unfortunately we don't have. You find this in the Global Financial Stability Report from the IMF. It's the April edition, and they also explain a bit more around this. It's a very interesting reading in case you're interested. Some people are taking pictures, so all right, good. All right, just briefly on geopolitical topics. I mean, there would be so much to talk about, but I think we need to keep it short here. So these are the geopolitical topics I think we need to be monitoring in 2026. And when I mentioned conflicts early on, right, these are the potential conflicts for next year. I said at the beginning, I think we have a much better understanding of some of the political dynamics. That's true for the Russian-Ukraine war. That's probably true for the Middle East conflict. US-China relations, we know are intense these days. Global trade conflict, the same. There might be new topics popping up, which we don't know yet. So the kind of unknown unknowns, so to say. So the things we don't know. Venezuela conflict is popping up. This is important. It's a small country, but it's important for global energy supply. So what I would be looking at for the next couple of months, clear priority on Russian-Ukraine conflict. Our view is that it still needs time to get to a ceasefire solution. And I personally have not and still don't understand the current excitement or optimism on the outlook on a ceasefire solution in the short term. I think the conflict will still be with us for a couple of more, months, I would argue. Some of these conflicts are long-term, US-China relations, global trade conflict especially, and then the big topic which kind of results from the US-China conflict is basically, are we moving from a unilateral world order into a more bipolar or multipolar world? And I think that's important also for companies, because that ultimately defines supply chains. This ultimately defines where I build up my production capabilities, etc. And again, I go back to a study from the IMF, which shows quite nicely how fragmented the world already is. And I think that indicates that we are more likely than not go into the multipolar direction going forward. And that may have some consequences which we do not understand today, and I think it's worth monitoring and going into the details going forward. So just quickly, on the left-hand side, again here, you see the number of trade sanctions, financial sanctions since the 90s, significant increase. This doesn't even cover the last 3 to 6 months, so you probably see an even higher number today. Then fragmentation index. is something the IMF came up with. It kind of aggregates, I think, 14 sub-indices on political uncertainty, on trade flows, on bilateral relationship, etc. It's a great index, and it also is clearly biased towards the upside. And this shows we are living in a more fragmented world. We have to deal with more supply chain constraints, and I think businesses and companies have to rethink their kind of supply chain policy. With that, I think before we show the official results, maybe you are interested in what our clients actually thought about the key risk in 26. Is that all right?
Yes, absolutely.
I show this now. It's a much longer list. All right. Again, no reason to go into every single line, but I thought it's quite striking because, so the question was, what do you think are the biggest threats to financial markets for the next 12 months and 5 years? So short term and long term. In the short term, global trade war, geopolitics, higher inflation. Admittedly, we have done this survey in Q2, so a few months ago, so global trade war was in everyone's mind. But ultimately, well, global trade war for me is a geopolitical topic, right, by definition almost. Long term, next 5 years, again, very different views on different topics, but the top three, geopolitics, again, global recession, all right, and then the debt crisis. Whether it's short term or long term, the key threat to financial markets from a family office and wealth client perspective, geopolitics. And I think that is something we need to be aware of. I agree with that view, especially in the long term. And I think we need to ask ourselves a couple of questions on the company level, but also from a pure asset allocation point of view. Thank you so far for listening. I think we're now going to see the results from our own survey.
Absolutely. Thank you, Dirk. Thank you for your insights. Thank you very much. And yes, we would now like to look at your answers from the Slido question. Dirk, would you like to stay with me?
Yeah,
and we can perhaps look at them together. There you go. So geopolitical instability has come in first place, followed by rising national debt, bond market jitters, an AI bubble, high inflation, and US trade tariffs has gone to zero. So is this because of the 2 quarters in between, the quarter in between, that just that shift in mindset, just because tariffs have come down in Switzerland, or also?
Yeah. I don't know. Well, we should ask our audience.
But you seem surprised.
But I am surprised, especially the 0%. Maybe I made my comments a bit too late, right? When I said that the tariff rate is actually 6 times higher than the beginning of the year, and that I would basically argue that the impact on the economy is still to come. But I think it's fair because it kind of reflects what's being discussed right now, and it's not tariffs. It's more geopolitical uncertainty. That's right, and it's more the debt level from major countries nowadays. So yeah, thank you for voting.
Thank you very much. Indeed. Could I just ask maybe 1 or 2 questions, and then I'll allow for a few questions as well from the audience before we close. Sorry, just on tariffs, you mentioned there as well that it could be decided by the Supreme Court that 70% of the tariffs were indeed illegal. What does that mean? Do they then get paid back? And would that not put additional pressure on the US? We saw their national debt. It's at very high levels in the US, and could that sort of push the fiscal finances to a tipping point?
Yeah, it's a good point. So what this would likely mean, so assuming the Supreme Court declares the IEPA, so-called IEPA tariffs, illegal, that would most likely mean that there will be a refund of tax revenues which have been collected from April onwards. All right, that's a challenge in itself, right? It's an administrative nightmare, I would argue. It probably takes time until those refunds will actually take place. And it's a burden for the fiscal deficit, which is already quite under stress, right? I don't think it will I don't think it will be a catalyst for a kind of
Tipping point. Of
how
recession.
did we call this bond market turbulences, etc. But it's a real test. It's a test. Probably the long end of the yield curve will probably increase because the investor will demand higher risk premium for U.S. Treasuries, and that will be a test for the U.S.
Great.
And maybe just one last point on this. Even if the tariffs are being declared illegal, I personally think that the Trump administration will find alternative way to build up the tariff war, which then over course will kind of compensate for the loss in tax revenues, I guess.
Okay, thank you. One last question as well, just from me on AI. I wanted to ask if you're concerned about the circular deals among some of these tech companies. For example, NVIDIA investing in its client OpenAI at the same time as OpenAI has or says it will partner with NVIDIA's rival chip maker AMD. Isn't that looking all a bit sort of incestuous, or do you see a risk of contagion if things go wrong?
So those companies trust in each other. That's positive. I am concerned. I just want to start with something positive. No, I'm concerned. Not that I think that this in itself will kind of lead to systemic risk, but once we see trouble popping up or kind of increasing, it definitely increases the risk of spillover effects, right? Because if one company fails, then clearly, if you have these interconnections, then another company will fall as well. So if something happens, then it clearly increases the risk of contagion, which is why I'm a bit concerned about this constellation. Yeah.
Excellent, thank you very much. Okay, now I'd like to give you the chance to ask one or two questions to Dirk, if you have any. Right, over here, the gentleman.
I do have a question on
Just on that. Could you just wait 1 second? The microphone's on its way.
I do have a question on the AI bubble. You mentioned that we are not yet peakish, but most probably it's still seen as an opportunity, the entire AI trend. But what is the UBS view on when we reach really the top, the peak of this bubble?
Yeah. I'm glad you asked about UBS view, not my view, but so our equity team in the house view is still that we are positive on the AI story and positive on investing in AI stocks. You have to be selective, and maybe it's not just about the big 7 or big 9, whatever, however you kind of categorize this. There's more to it. And again, in the year ahead, you find kind of more niche recommendations we do in this space. Yet, I think we have to be fair to say that valuation levels, right, in these companies are pretty high already. It's still lower than during the dot-com bubble, which gives me some comfort, at least. And I would be very careful in trying to predict. So first of all, there are two questions. Is this a bubble? And when will it, if yes, will it burst? I think we can see some early signs of a bubble buildup, but I wouldn't be brave enough, and I think we shouldn't predict the timing of the bursting of a bubble, because I think it's impossible, and usually it takes much longer than most people think. Which is also why we are still reluctant, because to actually recommend to sell, right? We still believe in our view that we have positive developments in front of us. Because the situation is different from the dot-com bubble. Companies have earn money, so they make some profits. That's a big difference towards the situation in 2000, 2001. You see debt levels of companies much lower than back then, and that's usually one of the catalysts for a bubble burst. And there are other indicators. If you show them side by side, usually they look much better today than they looked back then. So I have some comfort to believe that the rally will go on. It will be shaky, right? We have seen this over the last two weeks now. Well, we see the recovery over the last 3 days, but over the last 2-3 weeks, there have been some concerns. Markets went down, but recovered again. So I would trust the view of our equity analysts that over the next 12 months, at least, if you look through some short-term bumpy roads, development is positive. But again, the more that will be the case, the more I think we have to talk about the bubble risk.
Thank you.
Okay, thank you very much. Okay, I think we're going to leave it there. Thank you very much, Dirk. No more questions from the audience. Thank you very much.
Yeah, thank you.
Ladies and gentlemen, what an inspiring day it has been. A huge thank you to all our speakers in both the morning and the afternoon session, and of course to our sponsors. Thank you also to our panel moderators, our hosts Lorna and Michael, and all the team behind the scenes who made today possible. It's been wonderful to see your active participation, from sharing your thoughts on Slido to engaging in this afternoon's breakout sessions. Please continue to connect, share ideas, and explore the topics that we've talked about today. And I can already give you the date for next year's conference, which will be the 20th Investor Relations Conference, taking place on the 26th of November 2026. So it's a good one to remember. On behalf of SIX Swiss Exchange and the IR Club Switzerland, thank you for being part of the 19th Investor Relations Conference. We look forward to welcoming you back next year. Have a safe journey home and enjoy the rest of your day. Thank you.